Welcome, ladies and gentlemen, to Lesson 10, Managerial Decision Making. In this lesson, we're going to understand the managerial decision-making process. We're going to learn the difference between relevant and irrelevant costs, go through the different types of management decision-making, or go through different types of management decision-making, including keep or drop, make or buy, special order, and use of a constrained resource. All right, let's get started. Have the Lesson 10 cheat sheet in front of you. Flip it over, or make sure you have the concept and definition side up first. We're going to go through some concepts and definitions, and then we're going to get into some examples. First, start at the top left here. We're going to go through the managerial decision-making process. Step 1 in the decision-making process is identify the decision problem. You're going to have, there's going to be a problem is going to come up, and you're going to need to make a decision. Step 2, determine the decision alternatives. Step 3, evaluate the costs and benefits of the alternatives. Step 4, make the decision. Step 5, review the results of the decision-making process. And that blends back into if the result of that decision-making process was bad, well then that's a problem, and you probably should identify some alternatives, and then the process repeats itself. A couple cost definitions to talk about. All right, a relevant cost is a cost that differs between alternatives. All right, in the decision-making process, step 2 is identify alternatives. We're going to have two alternatives most of the time, in alternative A and alternative B, and relevant costs are those costs that differ between the alternatives. So a relevant cost analysis has two steps. The first step is eliminate costs and benefits that do not differ between alternatives. If it doesn't differ between the alternatives, it's not relevant. Use the remaining costs, those costs that do differ, and put those into the decision-making process when you're deciding between the alternatives. A sunk cost is a cost that has already been incurred and cannot be avoided regardless of the decision. Sunk cost. Future cost, a cost that does not differ between alternatives and is never a relevant cost. So future costs, never relevant to the decision-making process. Avoidable cost, a cost that can be eliminated in whole or in part by choosing one alternative or another. Avoidable costs are relevant costs. Keep that in mind. Avoidable costs are relevant. Unavoidable costs, a cost that cannot be eliminated in whole or in part by choosing one alternative or another. Unavoidable costs are irrelevant. Avoidable costs relevant. Unavoidable costs irrelevant. Why? Because an unavoidable cost, it's not relevant because it's not going to differ when you make a decision. The alternatives, both of them are going to have that cost. It's unavoidable, so it's irrelevant. All right, let's go to the top right here. Number 1 in red there, it's relevant versus irrelevant cost example. Jack, a college student in Los Angeles, has purchased tickets to a 3-day music festival in San Francisco's Golden Gate Park. Sounds like fun. Jack now has to make the decision between driving or flying to San Francisco from Los Angeles. Jack averages 15,000 miles per year on his car, which costs him $20,000. His car gets 35 miles per gallon of gasoline. He estimates gasoline to be about $3 per gallon. Jack's historical repairs and maintenance costs have averaged it's 0.097 cents. Okay, so it's less than 9 cents. Well, more than 9 cents, but less than 10 cents per mile. Okay, so what we need to do is we need to come up with what our costs are. What are the costs of the automobile? So we have depreciation on the automobile. We have the cost of gasoline. We have insurance and license. We have maintenance and repairs. We've got parking fees at Jack's school. So what we do is we identify all those costs associated with the car, right? Because if we drive, we're going to incur costs against that car. So some of the relevant costs, well, so let's identify all the costs. So the annual straight line depreciation on the car, so it's $20,000 less. Jack thinks he could get $6,500 for it after 5 years. So the annual depreciation is $2,700. All right, and which averages, well, when you take his average annual mileage of 15,000, you get to 0.18 cents, or 18 cents. So 18 cents per mile is what Jack's depreciation is. Cost of gasoline. Jack gets $3, so gasoline costs $3 per gallon. Jack gets 35 miles per gallon. So Jack's average mile, right, cost per mile is 0.085. Annual cost of auto insurance and license, his annual cost is $1,280. You take that divided by the 15,000 miles that he averages per year, or yeah, you get 0.085. Sorry, on the gasoline I was incorrect. It's the 0.086. Now on the annual auto insurance is 0.085. You guys can look. Now the maintenance cost and repairs, or the maintenance and repairs cost we were given, and Jack says he's historically averaged 0.097 cents. And then parking fees at Jack's school on an annual basis are $540. You take that divided by his annual miles, you come up with a cost per mile for parking of 0.036. So all those costs added together, you get an average per mile cost for Jack of 0.484. Some additional costs and benefits to the trip that Jack's identified. Reduction in resale value of Jack's car per mile of wear. Jack's estimated that to be 0.016. The round trip airfare is $150. Benefits of saving time from flying. Okay, that is a cost and a benefit, but it's hard to quantify. Cost of paying neighbor to feed cat while out of town. Well, that's too bad that Jack owns a cat for all the cat people. But anyway, that's going to cost him $40. Cost of paying neighbor, benefit of having a car in San Francisco. Okay, that is a benefit, but it's hard to quantify. Hassle of parking car in San Francisco. Well, you know, that's also a cost, but it's also hard to quantify. Per day cost of parking in San Francisco, well, that is an easily identifiable amount. It costs about $25 per day to park your car at a hotel here in San Francisco. Cost of taxis and public transportation. If Jack's staying in a hotel, he's going to need to get to Golden Gate Park, and he's going to need to take public transportation and a taxi, or a taxi. Probably a taxi because the concert's going to get out late at night. So Jack's estimated that cost to be $45. And then the cost of the concert tickets. Though that cost Jack $275. Pretty expensive concert, but it is a 3-day music festival, so that could be worth it. So we've got all those costs, and those are sort of the all the costs and benefit that Jack's identified for this decision. Now we need to identify which costs are relevant and which costs are irrelevant. Okay? So, number one, annual straight line depreciation on car. That's really an irrelevant cost because it's unavoidable. It's a sunk cost. He's already paid for it. It's going to happen no matter how much he drives. So it's an unavoidable cost. Remember, unavoidable costs are irrelevant. So that depreciation is irrelevant. Cost of gasoline. Well, if Jack decides to drive, he's going to have to pay for the gas to go up to San Francisco. So yes, that's a relevant cost because he can avoid that by flying, right? So an avoidable cost, or a cost that differs between alternatives, is relevant. So that's a relevant cost. Annual cost of auto insurance. Well, that's irrelevant. Whether he drives or not, he's going to have to pay that annual cost. So it's unavoidable. Unavoidable costs are irrelevant. Maintenance and repairs. Yes, if Jack drives the 350 miles to San Francisco, he's going to actually have to pay more in maintenance and repairs for that year. So yes, that's a relevant cost because it's avoidable. If he flies, he doesn't have to pay that additional maintenance and repairs. Parking fees at school. Whether he flies or drives, he's going to have to pay that annual expense, right? So it's not, it's actually unavoidable. Unavoidable costs are irrelevant. Now, let's go to the additional costs and benefits. Reduction in resale value of car per mile of wear. Yeah, Jack's going to drive additional miles. Those additional miles are going to be wear and tear. It's going to reduce the value of his car. So yes, it's a relevant cost because it can be avoided. If he flies, he doesn't incur those costs. If he drives, he does. Round trip airfare. Yes, that's relevant because if he drives, he doesn't have to pay it. So it's a cost that differs between all alternatives. Benefits of saving time from flying. It's hard to quantify, but it's relevant because if he drives, he doesn't get the benefit of saving time. Cost of paying neighbor to feed the cat while out of town. Well, if he drives or flies, he's going to be out of town, right? So that's an unavoidable cost. Unavoidable costs are irrelevant. Benefit of having a car in San Francisco? Well, if he flies, he's not going to have his car, so it's a cost that differs between alternatives. So yes, it's relevant. Hassle of parking car in San Francisco. Although it's hard to quantify, it is relevant because if he doesn't have his car, he doesn't have to go through that hassle, so it's avoidable. Next is the per cost of parking car in San Francisco. That is avoidable because if he flies, he's not going to have to pay for parking. The cost of taxis, it's relevant because if he drives, he's not going to have to pay for public transportation parking. So it differs between the alternatives. And then the last one is the cost of the concert tickets. That's irrelevant. Whether he flies or drives, he's already incurred that cost, so it doesn't matter. Irrelevant. So now let's summarize the relevant costs of driving and the relevant costs of taking the flight. Relevant costs of driving are gasoline, maintenance, reduction in resale, and parking. All right. So if he drives, Jack is going to incur all these costs, $144.55. If Jack flies, he's going to incur these costs: the taxis, the public transportation, and the round trip ticket. So that's $195. So if Jack is really cost conscious and worried about his cash outflow, he would drive. If he was more inclined to say that he wants to benefit from the time he's going to save and not having to deal with parking, then maybe those benefits outweigh the additional $50 cost that he'll incur. So anyway, that's the relevant versus irrelevant cost example. Let's go down to 2. We'll talk about differential analysis example. Management at HMS Roundbelly Inc. is considering renting an automated aluminum press that would cut labor costs in the production of their 14-foot aluminum boats. The machine will cost $640,000 per year, but is expected to cut direct labor costs per boat by $8. Management at Roundbelly has put together the following analysis to determine if the acquisition of the machine would be beneficial. Okay, so we've got the current situation. We've got current sales. We've got current direct materials, current direct labor, variable overhead, and then our contribution margin. Then we've got our fixed expenses and our net operating income. Net operating income is $8,691,395. Now, if we get the new machine, our sales is going to stay the same, direct materials is going to stay the same, but we're going to reduce our direct labor hours. We're going to reduce our direct labor hours, I think it was by 8 hours, or $8 per direct labor cost by $8 per boat. So that gets us a differential cost of $813,200. So that increases our contribution margin by that much. But if you look down below, you're going to see that the rent on the new machine is also a differential cost, and that rent on the machine is $640,000. But the savings in contribution margin outweighs the cost, so we're in a net operating income increase position of $173,200. So that is a beneficial decision. Now, if you look over, if you go over underneath number 6, I know it's kind of awkward, but it's the same color. You have net advantage to renting the new machine, and this really only takes the relevant costs and the differential cost, which is the $813,200 and the $640, and you get to that same net operating income increase, and that's really the relevant cost right there. All these other costs are irrelevant because they don't differ between the alternatives. Let's move from 2 to 3. 3 is up here in the top left. Keep or drop decision. HMS Roundbelly Inc. is currently analyzing the profitability of its product lines and notes that the 16-foot catamaran product has been losing money for several years due to declining interest in the market. Roundbelly has considered dropping the product. Below is the relevant information Roundbelly management has gathered. Roundbelly will drop the product line only if doing so increased profits, i.e. fixed cost savings is greater than lost contribution margin. That'll make more sense when given the problem. Management at Roundbelly has further noted that the factory overhead and other fixed costs would not